How do you defend against a swarm of $2,000 drones without going bankrupt? Well, apparently you stick a high-power laser onto a fighter jet and fly it above the clouds.
Simple, really. Just physics and a lot of cash.
Right. It is March 17th, 2026. We are looking at Elbit Systems, ticker ESLT, and their Q4-25 results. And honestly, this is a milestone quarter for them. They finally crossed that $2 billion mark, hitting $2.15 billion revenue, up from $1.92 last quarter. Non-GAAP EPS came in at $3.56, up from $3.35, and operating margins ticked up slightly to 9.8%.
The headline numbers are solid. But when you see a defense prime suddenly scaling top line by almost 12% quarter over quarter, that is, it is just not a normal peacetime environment. That is an industrial base practically choking on global panic. The sheer volume flowing through their ISTR and electronic warfare unit alone is wild.
Yeah, that was up roughly 34% sequentially, right? Hitting something like $456 million.
Exactly. And the market completely absorbed that narrative today. After a really choppy U-shaped quarter, the stock just went on a relentless run during the actual earnings session. Opened high, never really looked back, and closed up over 8.5% near $1,014.
Which is honestly a massive move for a legacy defense stock. And actually, quick pause, just our standard reminder that this is all strictly our personal opinion and absolutely not financial advice. Do not go day trading defense contractors just because Miro makes lasers sound cool.
I do not make them sound cool. The math makes them cool. Look, the whole industry has a severe math problem right now. Firing $500,000 interceptors at cheap plastic drones is, well, it's a great way for a sovereign nation to go bankrupt. Elbit is trying to shift the entire economic model by using directed energy weapons. And putting them above the weather means you bypass dust and turbulence, which usually ruin ground-based systems.
So you get a clean shot at swarms far from any borders. I mean, that is... Wow, that is literally science fiction becoming an operational necessity.
Right, but building that reality is causing some serious structural friction behind the scenes. They're running 3 shifts, tripling factory footprints, pouring robots onto the assembly lines just to clear a backlog that's now north of $28 billion.
Okay, yes, the backlog, because that $28 billion number is massive. And figuring out how they actually plan to pay for all that new manufacturing capacity without completely crushing their cash flow is, well, it's the real story here. All right, let's get into the details.
That is the exact friction point. When I saw the guidance that capital expenditures are, stepping up from roughly $200 million historically to around $300 million in 2026, my first thought was they are going to burn massive cash just to pour concrete.
Right, because tripling factory sizes is not exactly cheap.
It is not, but the reality is actually much stranger. The CEO literally said on the call, actually, every dollar that we invest, there is an additional investment by our customer. So the buyers are directly co-funding the physical capacity.
Wait, let me just process that. Buyers are so desperate for systems that they are fronting the money for the factory blueprints? That is wild.
They have to. Look at Europe. You have all these nations suddenly waking up to depleted stockpiles. But there is a huge political catch. You cannot just hand billions of sovereign defense budget to an Israeli contractor without massive domestic backlash. The capital has to stay somewhat local.
Oh, of course. The classic, we need weapons yesterday, but we also need local union jobs problem.
Exactly. So Elbit solved this beautifully with what they call the Europools architecture. Pools is their rocket artillery platform, right? Instead of selling a closed box, they package it as open architecture. They go to a local European prime, someone like a KNDS, and say, here's the bare launcher. You write the software and integrate your own domestic missiles on top of it. They completely localize the joint venture.
That is just incredibly smart geopolitically. You completely bypass the nationalist red tape. But getting back to the actual production bottleneck, Snagging a $28 billion backlog is one thing. Actually building it is the issue. Because, correct me if I'm wrong, backlog grew 24% this year, but revenue only grew 16%. There's a logjam somewhere.
Yes, there is a clear bottleneck, and it's partly just the physical limit of how fast human hands can safely assemble munitions. But the deeper issue is the supply chain chokehold. The Red Sea shipping disruptions really wrecked their logistics over the last year. So they aggressively vertically integrated. I mean, they're literally engineering their own optical diodes and detectors internally now just to keep the electro-optic lines moving.
Geez. So they're basically pulling the entire raw material chain inward because the ocean routes are just too fragile.
They are, and that shift puts immense pressure on working capital. If you look at their balance sheet, short-term contract liabilities surged by over $350 million in just one quarter, up to $2.6 billion. That is a mountain of customer advance payments just sitting there. They have the cash, now they have to execute. The CFO, Kabi Kagan, made a very specific point about this. He noted there should be convergence between those two numbers.
Between the backlog growth and the revenue, meaning top line is going to have to sprint to catch up.
Right. He is forecasting substantial double-digit growth because once these new robotic three-shift factories are fully humming and the localized diode supply is stable, the revenue spigot just fully opens.
Okay, assuming the geopolitical cycle does not suddenly reverse. But what about the profit profile? They said they want to expand operating margins by about 1% a year. Is that actually realistic while they're ripping up and rebuilding their entire supply chain?
I think the underlying operational leverage is real, but you do have to scrub the quarterly numbers a bit. The non-GAAP net income looks super clean, roughly $170 million, but GAAP had this one-off $13.7 million capital gain from, of all things, terminating pension plans. Plus, they stripped out some non-indemnified costs tied to what they call special circumstances, which is basically the Swords of Iron War.
See, at what point does a special circumstance in the Middle East just become a permanent operating headwind? You cannot adjust that out forever.
Yeah, you really can't. It is the new normal. But honestly, putting the accounting quirks aside, the cash flow is just undeniable. They generated a record $553 million in free cash flow for the full year. That's a 103% cash conversion rate. They are basically a highly automated toll booth for global security right now.
Okay, so they have the cash flow, they have the political open architecture playbook in Europe, and they're literally building the robots to push the backlog out the door. So where does this actually leave their trajectory heading into the next few quarters?
It leaves them staring down an almost forced growth phase. Look, management is explicitly guiding for continuous double-digit revenue growth just to catch up to that order book. And the CFO, Kobe, he basically staked his reputation on expanding operating margins by another 100 basis points annually from here.
Which is incredibly bold. I mean, trying to squeeze out another % of profitability while you're simultaneously, hiking CapEx up to $300 million next year, that is threading a very tight financial needle.
It is, but the operating leverage is already there if they automate effectively. My bigger question looking ahead is cyclicality. I think the market is treating this geopolitical pressure cooker like it stays at a rolling boil forever. What actually happens to these massive new factories if sudden peace breaks out?
Well, wouldn't that be nice for a change? But I think they addressed that almost too bluntly on the call. The CEO literally said, quote, "As in the Middle East, as one conflict ends, another begins."
That is a remarkably dark outlook for a corporate earnings call, just pure unvarnished realism.
Yeah, and frankly, even if the local front does cool down, they have completely shifted their center of gravity. Management expects Europe to remain the principal driver of international growth going forward. Because of those joint ventures, they are structurally entrenched over there now.
Exactly. They engineered a long-term hedge against localized peace. So going into next quarter, the demand risk is roughly, well, it is practically zero. The only real risk is execution. If the automated lines misfire or that localized supply chain hiccups again, that $28 billion backlog becomes a massive delivery liability.
Right, because building one airborne laser is an amazing science project. Delivering them reliably at scale is the actual business test.
Precisely. They secured the capital and they drew the blueprints. Now we just watch them pour the concrete.
Let's just hope the new assembly robots are good at mixing cement. All right, I think that is a solid place to leave it.
All right, we will wrap it up right there. To have these chats just show up when reports drop, hit follow on your app. And as a quick aside, this podcast is actually generated by AI, which is wild since it reads these giant transcripts instantly. Got a ticker you want us to dig into next? Just shoot an email to earningsunscripted@datamadness.ca or grab the X link in the show notes. Thanks for listening, and we will see you next time.
Take care.